There's a spreadsheet that gets passed around financial planning forums. It shows what happens when you invest $500 a month for 30 years. The final number is usually somewhere around $700,000, sometimes more. People screenshot it, they share it, they feel helpful. Then they check their bank account and realize they've been contributing $500 a month for 3 years and have about $19,000. Something doesn't add up. And the gap between the spreadsheet and reality is where most wealth-building advice quietly dies. $500 a month is the magic number that shows up everywhere. Financial advisors use it, retirement calculators default to it. It's specific enough to sound real, but vague enough to feel achievable. The math behind it isn't a lie, but it's not exactly the truth either. Because the $700,000 projection requires 3 things most people don't think about when they see that number. First, you can't miss a single month, not one. Second, the market has to cooperate for 3 decades straight. And third, you have to pretend inflation doesn't exist. Let's actually run the numbers, not the optimistic ones, the real ones. When someone says invest $500 a month, they're usually talking about index funds, boring, diversified, tied to the stock market's long-term average return. That average is roughly 10% per year, except it's not really 10%. It's closer to 7% after you account for inflation. Some years it's 30%, some years it's negative 15%, but over long enough timelines, the average holds. This is where compound interest enters the conversation, the idea that your money makes money and then that money makes money, and eventually the growth starts outpacing your contributions. Year 1, you put in $6,000. At 7%, you end the year with around $6,400. Not impressive. Year 5, you've contributed $30,000. Your balance is closer to $36,000. Still feels slow. Year 10, you've put in $60,000. Your account shows around $87,000. Now it's moving. Year 20, you've contributed $120,000. Your balance is $259,000. The growth is finally outpacing what you're adding. Year 30, you've invested $180,000 of your own money. The account reads $612,000. Not quite the $700,000 the spreadsheet promised, but still, $612,000 sounds like serious wealth. Except that's in future dollars, and future dollars are not the same as today's dollars. Let's rewind and add the variable everyone quietly ignores: inflation. If inflation averages 3% per year, which is roughly what it's been historically, then $612,000 in 30 years buys what about $250,000 buys today. Not nothing, but not retire early and buy a lake house money either. And that assumes you can actually keep contributing $500 every single month for 30 years without interruption. Think about what 3 decades actually contains: job changes, medical emergencies, kids, a car that dies at the worst possible time, a global pandemic, a recession or two. Life doesn't pause for your retirement spreadsheet. The average American has around $5,000 in savings. The median income is $60,000. After taxes and basic expenses, $500 a month is 15% of take-home pay for a lot of households. Saving 15% consistently is possible, but it requires a level of financial stability and discipline that most people don't achieve until their 30s, which cuts the timeline down to 20 or 25 years instead of 30. Run the same calculation with 25 years. $500 a month at 7% real returns. You end up with about $398,000. In today's dollars, that's closer to $185,000. Still significant, but it's not wealth, it's a cushion. Here's where the math gets cruel. The order in which you experience gains and losses matters more than almost anything else. This is called sequence of returns risk, and it's the reason 2 people can invest the same amount for the same length of time and end up with wildly different outcomes. If the market crashes 20% in year 2 of your investing journey, it barely matters. You're buying shares at a discount. The recovery benefits you. But if the market crashes 20% in year 28, when your account is worth $500,000, you've just lost $100,000, and you have 2 years left to recover before you might need that money. The closer you get to the end, the more dangerous volatility becomes. This is why target date funds exist. They automatically shift your portfolio from stocks to bonds as you age, reducing risk as you approach retirement. But bonds return less, so you're trading growth for safety, which lowers that 7% average even further. The real number might be closer to 5 or 6% by the time you factor in the gradual shift to conservative investments. 6% over 30 years with $500 a month gets you to about $500,000. Adjust for inflation, you're looking at about $200,000 in today's purchasing power. That's the actual number hiding behind the headline. This is the part where personal finance influencers would pivot to motivation. They'd tell you $200,000 is still amazing, that it's better than nothing, that compound interest is still magical if you just believe. But you already know that. What you probably want to know is whether the entire premise is broken, whether $500 is even the right benchmark, whether there's some other strategy that actually builds the kind of wealth the spreadsheets promise. The honest answer is that $500 a month works, but it works best for people who start early, never stop, and live through a cooperative market environment. If you start at 25 and retire at 65, you're golden. You'll probably exceed the projections. If you start at 35 and face a major crash in your 50s, the math gets uglier. And if you're in your 40s trying to catch up, $500 a month isn't going to get you there. You'd need to double or triple that contribution just to end up in the same place someone who started earlier reached with less effort. Time is the actual compounding variable. Money just rides along. Here's what the $500 a month narrative obscures. Wealth in America is not primarily built through disciplined monthly contributions to index funds. It's built through ownership, equity in a business, real estate appreciation, stock options that actually vest and grow, inheritance. The people who end up with multiple millions didn't get there by contributing $500 a month for 40 years. They got there by owning something that multiplied in value. Index fund investing is wealth preservation. It's how you keep money working instead of rotting in a savings account. But it's not how you build transformative wealth, unless you're starting with a significant base or contributing far more than $500 a month. The math is clear on this. To retire with $2 million in today's purchasing power using only monthly contributions, you'd need to invest around $1,500 a month for 30 years at 7% real returns. $1,500 a month is 36% of the median household income. It's not impossible, but it's also not the accessible, everyman strategy the $500 narrative suggests. So, what are you supposed to do with this information? You could decide the whole thing is rigged and stop contributing entirely. That's statistically the worst option. Doing nothing guarantees you end up with nothing. You could keep contributing $500 a month and accept that it's building a cushion, not an empire. That's the rational choice. It's boring and unglamorous, but it works within the constraints of reality. Or you could treat $500 a month as the floor and spend your energy figuring out how to increase your income, reduce your expenses, or find asymmetric opportunities that might actually change the trajectory. The uncomfortable truth is that personal finance advice has spent decades selling the same formula because it's simple and repeatable. Invest early, invest consistently, don't panic, wait. And for a certain slice of the population, that works beautifully. But the formula was designed in an economy where pensions existed, healthcare was affordable, housing was cheaper relative to income, and college didn't require 6 figures in debt. The variables have changed. The formula hasn't. $500 a month can still build wealth, just not the wealth the spreadsheet promises, and maybe not the wealth you actually need. The question isn't whether you should invest $500 a month. The question is whether you can afford to believe that's enough.